So oftentimes people associate the dollar amount with how hard it was to make that. Money is emotional. I mean, it's not just in the investment world and the retirement world, but we do get attached emotionally to money. Some of the headlines scare people.
Well, that's just reality. I work in the business.
My attitude and my opinion, Kamie, was it wasn't the tariffs that were scaring people. It was the unknowns. It was the uncertainty.
Do you think greed comes into play when you have these smart folks making a bad decision investment-wise?
Absolutely. And I can tell you that not only has there never been a time where the market didn't come back, but the market came back and reached new highs again. I would focus more on what plan do you have in place and what's important. Welcome back to another episode of the Retire and Thrive podcast, where we help you live your life with purpose, wealth, and confidence.
This is Dan. He's our expert. I'm Kamie. And today we are talking about, doing things the smart way, I guess, or why sometimes smart people make bad investments. Maybe that's you, maybe that's a loved one, or maybe you don't want to be this person. You want to be the smart person, but not make the bad investment. So we are going to touch on that. And we're also going to touch on the emotional side of things and how there can be some stress when it comes to our finances and financial decisions. And there can also be some anger. There can be frustration. There can be a lot of emotions. There can be happiness too. We like that.
Yeah.
And we like when things have been done the right way, but that's not always the case. So Dan, how are we starting this week? What would you like to talk about first?
Great. So when I think about emotions, in our world, we call it behavioral finance. I mean, it's kind of a fancy word.
That is fancy.
To just say people get emotional.
Yeah.
And it's real. And I've seen it. And I can't imagine a world where people don't get emotional. I mean, this is money they've worked their entire life to build up. And then all of a sudden, the markets drop. And, we get calls frequently where somebody's like, oh my gosh, I just lost $20,000.
Mm-hmm.
And I'll say, that's 1% of your portfolio. And they're like, oh, I never thought of that. So oftentimes people associate the dollar amount with how hard it was to make that and to accumulate it over those years. So money is emotional. I mean, it's not just in the investment world and the retirement world, but, we do get attached emotionally to money.
Yeah. And a lot of that is emotional in the moment. And I'm sure you're there to help guide people through the process and say, okay, just hold on.
Yeah.
Just hold on. And that can be tough for some folks. So let's talk about some experiences that you've had. I'm sure you've dealt with some clients. You look at these people, smart people, they make smart decisions. They know what they're doing, but it didn't work out for them. Right. Do you have any clients that you can think of, or maybe it's something that you've done?
Yeah, absolutely. I could tell you many, many stories, but I think when I look at the emotional side of this, Kamie, I'm going to just take a step back before sharing any stories, because I feel like there's two killers to investments, and it's driven really by fear and greed.
Mm-hmm.
And the fear is real. That's the emotional part that we're talking about. The fear of, oh my gosh, I'm watching my entire nest egg crumble. We had someone in the other day, and they were in their 60s, and they were talking about how, it's taken me 35 years, and this could go to zero. And so we kind of stepped back and it's like, could it really go to zero? Because if you own a diversified portfolio and they have 500 companies, let's just use like the S&P 500 index, that is the 500 largest publicly traded companies in America. And we haven't really got into a lot of the investment, strategy or detail, but at the end of the day, the S&P 500 is the 500 largest publicly traded companies. And when you own those, you are a part owner. So the only way that goes to zero is if that company shuts their doors.
Right.
So we could never live in a world, or I couldn't envision a world, I should say, where all 500 companies are out of business. Because if all 500 companies were out of business, you and I would not be sitting here today.
Right. So that's important to bring that up.
Right. So as a stock investor, you own a piece of every one of those companies if you're in a diversified, either in an index or a mutual fund or some type of portfolio.
Mm-hmm.
So that's the emotional side of the fear. And what's interesting is on the other side of the coin is the greed side,
right.
And it rears its head. I'll be completely honest, and I think a lot of that. I don't necessarily want to say keeping up with the Joneses, but people do talk, and we've heard it. It's like, well, my neighbor got 14% and I see I'm only up 11. And so we've had those discussions before where it's like, hold on. How old is your neighbor?
Right.
What's your neighbor's total picture? Let's not compare you to them because you might be at different stages or your portfolio might look a lot different than theirs.
Yeah, very situational.
Right.
That's for sure.
And so I think for me, and looking at, again, most of our clients are either approaching retirement or they're getting, or they are retired. But I think the number one fear that we witness for people, it's kind of like, back in the first quarter, the big buzz and the big concern was tariffs. What's going to happen here? And my attitude and my opinion, Kamie, was it wasn't the tariffs that were scaring people. It was the unknowns. It was the uncertainty. And markets, quite frankly, don't like uncertainty. Markets don't care about tariffs, or they don't care about COVID, or they don't care about real estate downturns or technology downturns. That's not what the market concerned about. They're concerned about what's it look like on the other end of this. Mm-hmm. And so I think for us, when we see people approaching retirement or they're retired, the number one concern isn't tariffs, but it's how is that going to affect me? But more importantly, is this going to basically put me to a point where I either A, have to go back to work or I have to cut my income? And am I ever going to run out?
Mm-hmm. Yeah, that's fear for sure.
Yeah, and it's real. I mean, that's, and I've mentioned this before to you too, that's the number one question that people ask us is, am I going to run out of money?
Right. And that's a fear that I'm sure a lot of people have at any age because you don't quite know fully how it works and how it's going to work. No one can predict the exact future. Let's touch on that emotional side. And when we're looking at investments or we're looking at retirement, how do you work with your clients to help calm the nerves and to help, even if it's not a client, maybe it's just Joe Schmo on the street that's about to retirement. How can he help himself not be so fearful of what's to come?
I feel like a broken record when I say this, but if you have a plan in place, that can alleviate a lot of stress. And so sticking to the plan, whatever that might look like. The other thing is, and I'm not going on record necessarily saying this affects everybody, but when I look back historically at the stock market, we've gone, every 3 to 4 years, the stock market will go negative. The fear is that it's not going to come back. And I look at my career over the last 30 plus years, and I can tell you that not only has there never been a time where the market didn't come back, but the market came back and reached new highs again.
Right.
I think the uncertainty is, when is that going to happen? And so, just think through this logically for a minute. And I keep using the round numbers because it's easier in my head. But if I'm 65 years old and I've worked hard and I've got $1 million and the market drops 20% and I have half of it in stock, half of it in bonds. So let's say I'm down 10%, I'm down to 900,000. That's when people panic. And that's when people get nervous. But you don't need all $900,000 right now.
Right.
And that's how people sometimes look at things is, if I just dropped 10%, I need to cash everything out. But when you look at it over periods of time, we go through these peaks and valleys, but knowing that the market, be it stock and or bond market, has never not recovered should be somewhat comforting.
But for the folks that are already in retirement, that can be even more scary. Obviously, they don't have as much time, perhaps, as others that are just entering retirement. Say you're 65, 70 years old. How do you help those folks? Because you constantly use the word historically, the stock market. We hear that all the time, right? Historically, the stock market bounces back, but it can be scary when you're in that retirement age, you're well into retirement, and you look at some investments that you would like to do or some that you've done, and you're not really buying I don't know if I have the time to historically watch it bounce back. How do you help those folks?
Yeah, I feel like, and it kind of goes back to the last episode when we talked about that bucket strategy, right? If you've got 3-4 years worth of guaranteed income setting aside in that bucket number one, whether you're 60 years old or you're 75 years old, it's just about weathering the storm, and it's about time. And so it's a little bit of a corny analogy, or a corny phrase, but I think it's appropriate. It's not about trying to time the market. It's about how much time that you are actually in the market. So it's time in the market, not necessarily timing the market, because it's been pretty well proven that nobody knows when to get out and go back in at just the right time. So you need to withstand some of these volatile periods if you want that long-term success that, even when you're retired, to keep up with inflation.
Yeah. Let's go back to the title of this episode, Smart People Making the Wrong Investment Decisions or Bad Investment Decisions. How does this happen? And have you seen this happen?
Not sure if I should go down this path or not, but I do feel like some of the headlines scare people.
Mm-hmm.
And
that's just reality.
Not.
I work in the business.
I was going to say, not to get into your business.
I work in this business. It is reality.
But it does scare people. And I'm not saying news channels are intentionally doing that. But what I am saying is, if people focus on headline news and that's all they do, it is a scary world out there.
Mm-hmm.
I mean, there's not a week that goes by that I wouldn't be fearful if I sat and watched, all the different news channels. And of course, now there's lots of news channels that's just 24/7 and they're focused on one event.
Mm-hmm.
And so, I would focus more on what plan do you have in place and what's important. I mean, just, you frequently say, do you need a financial advisor? And I'm going to just tell you, here's an example where you don't need a financial advisor. If you retire and you got $1 million and you've got a pension plan and you've got a Social Security income and you maybe got a spouse that has one or both of those two, and you add everything up, and let's just say the total amount that's coming in is $90,000, and you're like, well, we only need 70 to live on, and your $1 million portfolio drops by 10%, it's okay.
Right.
As long as you're not buying aggressive or speculative investments, you're fine.
Mm-hmm.
You just got to weather the storm.
Yeah.
But if you panic, that's when things go south.
Sure. You mentioned greed. Do you think greed comes into play when you have these smart folks making a bad decision investment-wise?
Absolutely. I'm not at liberty to talk specific investments or specific types of stocks and or bonds or companies. But what I can tell you is this, that we work with corporate executives as well as others. And a lot of these executives get really tied into the company that they work at. Maybe it's a company that has continued to grow and grow very rapidly. Maybe they're at a senior level where they get these stock options or restricted stock units, and they've noticed their wealth has just gone up and up and up and up. And so what happens, Kamie, is I don't even know if I would say it's as much greed. It's probably some greed, but they get so confident that their company's just going to keep growing and growing and growing. And I can tell you there's very, very few companies that I look at over the last 20 years that haven't had their tough times.
Right.
And so, I look at it as if I'm an employee, be it executive or any type of an employee at a company, and their stock keeps going up and up and up and up and up. And I just feel like, boy, this thing's averaged 20%. And when we sit down with them over the last 5 years, and we sit down with them and say, look, the market's only averaged 10. Do you really think this is going to continue to outpace the market by a factor of 2x for the next 20 years? Absolutely. And guess what happens, Kamie? That company stumbles. They can't continue that growth rate. And so, yeah, I think the greed definitely plays a factor in that.
Has to play a big factor.
Because why? Why would you not want to have more money and do all of those things so that you can retire at 45 instead of at 65 or whatever it might be?
Yeah. And if you're looking at smart people who know what they're doing, that greed probably comes into play. That's for sure. What next? What next would you like to discuss?
I want to touch on this again, fancy word called behavioral finance.
Mm-hmm.
But I also want to just touch on the fact that one of the things we've noticed when people get really anxious, and there have been times, not very often, we call it talking them off the ledge, right? Before they throw the towel in.
Yeah.
Unfortunately, we have had some people in the last 5 years, we've probably had 3 or 4 people that have done that. Inevitably, every single person has said to me, probably shouldn't have done that. But things looked really gloomy or whatever it might be.
Right.
But it's not just the dollars that are at jeopardy here. It's their confidence. And we see it.
Yeah.
And so what can often happen is that people maybe make a bad decision about their investment portfolio, and then all of a sudden the markets go up and they're sitting in cash because they took all their chips off the table. And now they're questioning, A, when do I go back in? And B, now I'm fearful to go back in, and their whole confidence. And it's not just confidence about when to get back in the market, but it's the whole confidence of, is my retirement plan changing now? And am I going to run out of money? And it just kind of snowballs.
Yeah. Confidence is important, and money is related to confidence. I think of folks younger. You're looking at folks in their 20s. We're talking more retirement age. But if you look at people that are just getting into the industry, whatever it may be, you can tell if they're getting paid appropriately, that they can survive. There's some jobs where they're paying you minimum wage when you start, and that's tough in this economy right now, especially in the town that we live in. It's a little more difficult to live comfortably on a low wage, and you can see that confidence.
Right.
And when they do get the money they deserve, it definitely changes them.
And I would just, again, I'm just going to go a little bit deep here on the planning itself, because one of the things we have, and again, I talk about this often, is we're really big into technology and using technology tools to aid people in making decisions. So when we go through these challenging times where the markets do go down and the headline news is really poor and it scares people, when we put together a plan for all the clients that we have, one of the things that we talk about is we look at the probability of running out of money. It's going to be a little bit heavy talk here, but I'll make it very simplistic. One of the tools we have is something that we call stress testing. In other words, if things really go bad, what is the chance of you running out of money? And there's something out there, and if you're out there and you want to Google it, it's called Monte Carlo Simulations. And so what a Monte Carlo simulation really does is it takes everything that we have built, from everything from rates of return to inflation rates to what you're pulling out for a monthly income from your portfolio to tax rates. So it looks at all of these variables and it runs our software 1,000 different scenarios. And it literally will come back and say, out of these 1,000 scenarios, if we ran it for you, Kamie, it might come back and say, based on what you're pulling out, based on the assumptions we've made, if the markets did substantially worse, or if inflation spiked, we're going to create all of these market scenarios, good or bad. It'll come back with, out of 1,000 times, this is the number of times where you would not have either failed or had to modify your plan. And what we typically like to see is if somebody's in that 85% chance or greater, and in that particular case, 850 times out of 1,000, they would have never run out of money. So what's that have to do with anything? Well, again, taking the emotion out of the equation. If we came back to you, Kamie, and said, you have a 96% probability of success in retirement, and then all of a sudden the markets drop by 15% and you're panicking, and you call me up and you're like, Dan, this is not comfortable for me. I'm very nervous. I would quickly run a Monte Carlo simulation. I might say, you know what, Kamie? You were at 96% 6 months ago. The market's down 15%. Today you're at 92.
Sure.
You're fine.
So is that something you do?
Yeah.
Can someone at home do it? How does it work?
So that's built into our software.
You have it. Okay.
Yeah. So that's not, again, I suggested if you want to learn more about it to just go online and look at it. But I'm not aware of a consumer-driven product that allows you to actually do the stress testing, because a lot of the plans we build out, we do get asked that question. Can we do this at home? Mm-hmm. And, for the type of plans that we do, we'll spend 3, 5, 7 hours building out the plan.
Right.
And then this is just one component of it. But it gets back to this emotional thing and helping people not make bad decisions at the wrong time.
Yes. Part of your what? Behavioral finance?
Behavioral finance. Exactly.
Yes. That is good though. Because that's the numbers show.
Right.
And that should alleviate some concern you may have or some emotions. What's next? What else would you like to touch on?
I can't think of anything else in this lesson about reviewing your investments. We had talked about the importance of, in the first episode of lesson 2, that as you get closer and closer to retirement, that you're modifying those investments. Last episode, we talked about, the bucket strategy, the guardrails, and then this is kind of the emotional component. So I don't necessarily think there's anything more. Certainly you and I could talk for hours, but for the viewers, I think those 3 components or those 3 different episodes, I think that really ties into the portfolio. And what I'm really excited about is next week when we get into cash flow. Cash
flow. Everyone loves to talk about cash flow and to do it, how to manage it correctly. That is what we will learn, and some tips and tricks that Dan has for us. And we look forward to that next week. Cash flow. Looking forward to it.
Excellent.
Remember to subscribe to our channel. We thank all of our subscribers, and we drop a new episode each week. So if you do have your notifications on, it will alert you when we drop. Is it on Fridays? Is that typically when?
Typically, we release them on Fridays.
On Fridays. So you'll get a little alert on your phone, and you can watch the episode. You can scroll through to parts that interest you. And please pass along this episode to any of your friends or family that you think it can relate to. That's all from us for today. We'll see you next week.